The first one we are going to cover is the supply and demand. Supply and demand zones are price levels or areas where smart money are most actively trading, with the largest volume. So that helps us identify these levels and follow the smart money footsteps. If you look at any financial market, be it stocks, crypto, Forex, we should know that the markets move in certain cycles. They go from balance to imbalance, and the then market moves from imbalance towards balance. In other words, the market always chases efficiency, fair pricing, and a fair chance for both buyers and sellers to enter a market. A balanced price looks like this. It moves like a consolidated or ranging market. It essentially shows that buyers had the same strength as the sellers. Therefore, the market creates a choppy price action. The balance must be broken. It's how the nature of the markets is. And this break of balance is called an imbalance. An imbalance in the market is created once the market is pushed aggressively out of balance. This movement is often made by smart money and large institutions with very, very large amounts of money. Remember what we have said before. The market moves towards balance. We can apply this information because from this imbalance, the market will eventually try to rebalance itself. And the rebalance is indicated by two zones that we will talk about. These zones are called supply and demand zones. Let's start with to explain what is the supply. The supply zone is met within two types of price action. One type is the reversal supply zone. This zone is characterized by price going up, creating a ranging movement sideways, and going all the way back down. This whole price action is also often named as a rally, base, drop. The second type of supply is the continuation supply zone. This zone is defined by price action that drops significantly to the downside, then started a slow downtrend and breaks to the downside again. This whole price action is named a drop, base, drop. Now for the demand. We also have two types of price action within the demand zones. One type is the reversal. The reversal is seen by price going down, creating a consolidation or ranging market. Then the price breaks all the way upside. This movement is named as a drop, base, rally. Then the second type of demand is the continuation. The continuation is seen by a significant upside movement, then a slow upside movement, and another significant upside movement. This market movement is named a rally, base, rally. So you should be able to notice how the market is balanced. Then it breaks the balance and becomes an imbalanced or inefficient market. And the market looks to rebalance itself. As we have said before, the balance is when price is moving fair towards both directions. So in simpler terms, once a market is ranging, and an imbalanced market is when the price does not give fair chances to one party, either the buyers or the sellers. Now that we know what demand and supply are, we need to know how to identify them, and how can they be used by traders. The supply is a zone where the market has been balanced, and it suddenly broke the balance to the downside. So this zone is the supply zone. So knowing this sharp move has imbalanced the market. As we have said multiple times before, the market moves towards balance, and we wait for it to happen. This translates to waiting for the price to come back up into the supply zone. This gives traders a sell short opportunity, but under certain conditions that we will soon learn them. Now for the demand zone, it is essentially the opposite way around. The market has been balanced, then breaks the balance by price going to the upside in a very aggressive way. The zone where price has moved before the break is the demand zone. Now that the market is imbalanced, it wants to move towards balance. That translates into price moving back down to the demand zone. This gives traders a buying opportunity. We will soon see how to filter the moves in such a way we can identify high-quality zones. But for now, let's present how to identify the supply and demand zones using candlesticks. Finding and using these supply and demand zones is relatively simple, and it is done by following some steps. The first step is to look for a candle or a small series of candles with large volume that breaks the balance by pushing the price aggressively either to the upside or to the downside. In this certain scenario, this move is to the downside. Now that we have identified that candle, we move into the second step, which is to observe the candle previous to the candle that broke the balance. So to make sure we understand, we are talking about the last candle before the price has moved aggressively. So that is this candle. Now that we also identified the candle, we move into the third step, which is to take the high and low of that candle. so the high and low of the candle from the second step, and draw a zone to the right. You can do that by using lines, but the most common it is marked by a rectangle or box. And this rectangle zone is the supply zone. The supply zone is used if eventually price comes back up to rebalance the market. The price has a high probability of rejecting to the downside from the zone, and this gives traders an opportunity to snipe sell short positions. Now for the demand zone. The first step is to find an aggressive move towards to the upside, a move that breaks the market's balance. The second step is to identify the candle before the aggressive move. The third step is to mark the high and low of that candle, and we wait for the market to rebalance, by price eventually going down, and rejecting the zone to the upside, giving traders a setup for a buying opportunity. Now let's look in the charts and actually see what we have learned. The market is ranging, so we are in a balance market. This candle is significantly larger than the previous ones, meaning that this candle had the largest amounts of volume. This price action overall unfortunately does not imply usual large movements, so this might not be the best setup. And we will explain later how to find the best possible setups. But until then, the candle before the move is this. So we take the high and low of the candle. And this is the supply zone. What we expect for this market is for it to eventually and slowly come back up to rebalance. Point where the most often met scenario once price hits a supply zone is for it to reject to the downside and break the lows. So it finally rebalanced the market, and it met our expectations to reject to the downside. And soon after it also broke the lows, essentially continuing the downtrend. Another example. This is a clear, very aggressive uptrend, in which the market comes back down to rebalance. Then the market prints these two large upside candles. A balance broken to the upside marks a demand zone, and the demand zone is taken from the candle before the large movement. So this red candle, we take the high and low from this candle, and this zone is our demand zone. Our expectations is for price to rebalance itself by going back down into the demand zone, gathering enough liquidity, and then rejecting the demand zone to the upside, essentially breaking the last major high. Since we know this is an uptrend, we look for highs to get broken, and let's see what we get from following the upcoming price. So the price hits the demand zone, moves around for a bit, probably because it hasn't gathered enough liquidity yet. So we need patience. The key point is for price to not break below the demand zone. And soon after these large candles printed on the chart, rejecting the demand zone to the upside. And let's see if they can manage to break the last major high. And yes, they did. So far, we have learned the market structure, which teaches us how and why a market moves a certain way, and supply and demand zones, which are an entry strategy. To understand how high-quality supply and demand zones work, we must understand market structure. The market structure knowledge can be applied into the supply and demand, and this is what we are going to talk about now. So let's take a downtrend, which creates lower highs and lower lows. In downtrends, we look for supply zones, like this one right here. So applying market structure knowledge, we see this as a downtrend with bearish breaks of structure in the high time frame. On the downtrend, we expect a pullback to the upside. And as we have said in the first chapter, the pullback is a low time frame uptrend. So price action creates internal bullish breaks of structure. Knowing we have a supply zone right above, we would expect the pullback to end near the supply zone. So the price rejects down the supply. But pay attention, as most traders would probably just sell short right at the touch. And that can be a viable option. But the highest quality setup is as it follows. After the price hits the supply zone, we wait for the market to break the last low. So essentially we wait for price to create an internal bearish change of character. We do not place orders yet, as we have said in the first chapter. The change of character is the first big indication of the reversal, but the confirmation of the reversal happens after price pulls again back to the upside. Point where we should be able to recognize that there is another supply zone internally on the lower time frame. Supply zone where smart money places their sell orders, and for price to hit the zone, and continue the confirmed downtrend by breaking structure in the high time frame, essentially making a new high time frame lower low. Now for the demand zones. Considering a high time frame uptrend, so a market structure that goes up, pulls back to the downside, does not break the last lows, and it pushes to break the last high. This bullish break of structure confirms the validity of a demand zone. As we have said before, the demand zone is the last move before an impulsive push to the upside, a price push that breaks the market's balance. And most importantly, it is a valid demand zone because the market has respected the uptrend by making higher highs in the high time frame. After price has pushed out of balance, the market moves to rebalance, and that is done by pulling back to the downside. So essentially creating a low time frame downtrend with internal bearish breaks of structure. The target of the downtrend is the demand zone, because the demand zone is a rebalance of the market. So what we look for is price hitting the demand zone, having a rejection to the upside, and price breaking the last internal lower high. This move validates the reversal in the lower time frame, which means that the low time frame is soon looking to align with the higher time frame. And this validates another demand zone inside the lower time frame, in which we look for buying opportunities once price pulls back, hits the demand, aligns with the high time frame, and pushes to break structure of the last high in the high time frame, essentially creating a new higher high in the high time frame. Now let's check into the charts. This is the GBP/USD Forex pair on the 2-hour time frame. We already marked the zones for you on this chart example. We should be able to quickly and easily notice an uptrend. So let's start the analysis. We see an impulsive upside movement. Remember what we have said in the first minutes of the video. An impulsive upside movement with a large candle signals a potential upcoming uptrend that is currently unconfirmed. The confirmation comes when price pulls back, doesn't break the last lows, and it breaks to the upside. That is what we call a break of structure. And notice we called the E, break of structure. It comes from external break of structure. External meaning high time frame. So after price breaking the highs and setting a high time frame break of structure in an uptrend, we get a confirmation of a valid demand zone. Now we can see that this demand zone has not been hit yet. But there should be no problem. Successful and profitable trading is heavily based on patience and self-control. If a zone is not hit, instead of forcing the trade and going out of your plan, it would be a better idea to have patience for the right setup and respect your plan. The market has another push to the upside, pull back to the downside, marking a higher low, then a higher high by breaking the last high, and setting another external bullish break of structure. Now in this case, we did not have a good enough demand zone to take into consideration. The reason was mainly of this candle taking the previous lows of the demand zone, making it a risky zone to validate. So we just waited for price to keep repeating the uptrend structure by pulling back to the downside after the significant bullish movement. Then a large candle with increased momentum breaks all the recent low time frame lows and highs. So essentially, it created a low time frame or internal change of character. We are soon going into these zones to explain it in more detail. But first, let's continue the high time frame price action analysis. So after creating that trend shift inside the low time frame, it confirms a demand zone, which we can see. This demand zone would give a textbook perfect entry, an immediate bullish reaction right at the touch. Then, as we have explained in the lines presentation, a textbook perfect take profit would be at the last highs, because being in an uptrend, we expect the market constantly have external bullish breaks of structure. We have explained the high time frame charting, but remember from the first minutes this important part. An uptrend has a high time frame up movement, then a pullback. Now remember that in an uptrend, the pullback is actually a low time frame downtrend. So we are now zooming into this whole downside price action. We are moving from the 2-hour time frame into a lower time frame. Let's say the 30-minute. This one is completely fine because it's not very far from the initial high time frame, while being low enough to have a good understanding price action. So notice the downside movement, pull back to the upside, and break of the lows. This marks a bearish internal break of structure. The I from the break of structure stands for internal, and essentially the internal bearish breaks of structure keep printing. The market manages to break a lower high, which marks a higher high, and this movement is a bullish change of character inside the low time frame. The trend shift validates a demand zone. Now, if you wonder why this demand zone is taken from multiple candles, well, the demand zone is taken from the higher time frame. It's taken from one candle in the higher time frame after we have seen the first candle larger than the previous ones. The play and shift between time frames is very important. The price is the same in both time frames. The time frame doesn't change the price, but the price action is different between time frames. The price action shows how the market has moved around a price, and the movement is what helps traders identify good setups. The change of character shifts the trend into a low time frame uptrend, and it basically aligns the low time frame trend with the high time frame by creating internal bullish breaks of structure, up until the price hits the low time frame demand, fills the orders from the smart buyers, reacts very aggressively to the upside, breaking both, another internal break of structure, and breaking the external break of structure. This is the complex demand entry, essentially identifying a high time frame demand zone and executing in the low time frame. More than likely, many smart money traders had their buy orders on the top of the demand zone, with stop loss below the demand zone, and take profit right above the last high time frame external higher high. Why there? Because being in a high time frame uptrend, the expectations of the market's movement is to constantly break highs in the high time frame. Going back into the high time frame and zooming into the low time frame in this zone. So into this pullback, and this is how it looks. Pretty similar to the last one. We know there is a high time frame uptrend by the aggressive upside movement and the pullback printed afterwards. And this is the pullback, which is a low time frame downtrend inside a high time frame uptrend. It works similarly as the last market structure, with internal bearish breaks of structure in the low time frame essentially creating lower lows and lower highs. This structure repeats until the low time frame pushes the price up, breaks the last internal lower high, prints the bullish internal change of character, which validates the demand zone before the push. In this case, we have taken the demand zone only from this time frame and from one candle to make it more simple. But we can even go to a higher or even lower time frame to find an even more quality demand zone. But that is a bit overkill in my opinion. The very complex and advanced concepts are most of the times not worth it, because positives always comes with new negatives. And the negatives of setting a very difficult and complex strategy usually comes with missing a lot of trading opportunities. So anyway, after validating the demand zone, the price slowly trends down, hits the demand zone, gathers liquidity, and pushes the market up. This push can also create a new demand zone, which you can take from the lower or the higher time frame, depending on your preference. The best idea is to not go too far away from the initial time frame where you have made the main analysis on, then the same action as the last one. Low time frame aligns with high time frame and breaks the internal structure, and also the external structure in the high time frame. So it essentially continues the high time frame trend.